Hi everyone, it's Grant Abbott speaking, and never a dull moment in the world of self-managed superannuation funds. And in particular, some of your clients may have received, and we certainly forewarned about it, a letter from the Commissioner of Taxation detailing various potential breaches of the investment strategy rules. And we're going to be looking at that particular letter. Auditors of those funds were also in receipt of a letter, which was probably to me a lot more disarming than the trustees, although I'm sure the trustees were very scared. I want to have a look at the ins and outs. I'm not going to go into a deep dive with you guys, so I'm going to give you more the practical solutions and how to fire it up and really start to, I always look at this as like a game of tennis, is to now put it right into the trustees' court. Remember, this is just the thin edge of the wedge as far as I'm concerned. And I'll give you a couple of solutions around that. But I've also got to get to have time a little bit later on. We have released a couple of new documents apart from our updated investment strategy, one being a family allowance agreement in order to show dependency. And also, secondly, I have got a SMSF lending package. So whereas an SMSF lends to another party, whether it's an individual, arm's length, or more importantly, non-arm's length, such as a related trustee or a company. So I want to take you through that as well. So it's going to be a pretty jam-packed hour. But again, I'm going to, if you look at if you want to go into the in-depth and a lot of the issues, come along to the 12:30 session. But you guys already like ATO Docs users, so I don't think we've really got a big issue there for that perspective. So the Commissioner of Taxation, in fact, is really, I remember in 1999, the ATO took over from APRA, which prior to that was the Insurance and Superannuation Commission, although both pretty what we call lame duck regulators in relation to SMSFs. And it was felt that the ATO was going to be the best regulator to look after SMSFs primarily because they were really a tax issue and really aligned with small business. So the Commission came out, there was a lot of warnings. And I remember a good friend Dan Butler was saying, look, giving it to the ATO is like giving a sledgehammer to crack a walnut. And of course, all that fear and doom and gloom actually was pretty good. So the first decade, they really spent a good decade educating, going out with trustees, where the regulator started building up their profile in that space. And really, there wasn't that much anything untoward. And if you have a look at 1999 to 2009, that include the simpler super, all those changes. So we did have quite dramatic changes in that time. So it was good, actually, in my perspective, to have the ATO on board. And we saw around about 2007, maybe 2008, they started to get quite, I suppose, illuminative, moving from that education to more the rulings and guidelines, taxpayer alerts, etc., in relation to self-managed. And of course, there was the big contributions ruling, 2009, I think it's 2009/1. Then we've got the business real property rulings. Each of these go up to 60 or 70 pages. And of course, we had LRBAs at that time, and they themselves, the guidelines on the ATO website, went up to around about 100 or so pages. We also had a lot of National Tax Liaison Group superannuation meetings, which came up with some great strategies, great ideas, a lot of clarification. Now, a lot of that is now sort of bowed out. The Commissioner's virtually said that he's not really going to do those guidelines or rulings anymore, that everything will now be up on the website. So that now means that we're moving into a different phase. And I think that this is the first start of that phase, that now the Commission's got big data compliance and can go in to client funds, find out investment strategies, and more importantly, from that perspective, can pull out data as to what funds have more than 90% of asset allocations in a specific asset class. Now, mind you, obviously, all these warnings went to property SMSFs, and I'll just call that anything over 90% would be a property SMSF, as opposed to SMSFs that I've seen with large equity exposures or all cash. If you have a look at all cash, I mean, there's a potential risk there as well for lack of diversification with cash rates at such a low process at the moment of 1.8%. So from my perspective, this is the first shot over the bow. We're going to see a lot more of this, and to actually send out 17,700 letters, not only to trustees but to the auditors, is a pretty big task. And that the tweak for me has really been there was a switch around of the Deputy Commissioner of Taxation superannuation to John O'Halloran now, and he's moved on, or they made that change in December last year, I think, or early this year, and now obviously they're moving into a pretty hardcore compliance mode. So I expect a lot more of this. So one of the things that I was a bit surprised about that. And look, we see this when a client starts up a new fund, they do get a telephone call from the tax office, why have you set up the fund, so on and so forth. So there's a lot more intrusiveness into that trustee role, and in particular the auditors. For the auditors on this session, I mean, at the end of the day, you are the compliance kings or the compliance backstop for the tax office. It's a lot easier for the tax office to notify you as to what they need, and then let you guys go ahead and make sure it's enforced. You can see that there's quite a lot of action about auditors being removed, etc. So we've really got to take that on board and know that this is the first shot at the bow. Really, from all of us is, look, there's strategies, there's still strategies. It's important for us to go down the track, but to make sure they're properly documented is the crucial aspect for us. So let's just have a look. What is a strategy? The Oxford definition is a strategy is a plan or course of action to achieve a certain goal. So if we have a look at that and we have a look at the guidelines, the audit guidelines, and we can relate to investment strategy, it's essentially a plan or course of action to meet the fund's investment objective. So we need to set in place an investment objective and then a plan to get that or move towards that. An investment strategy is not a backward-looking document. Unfortunately, it's been too easy, and I think it's actually I think there's a lot of exposure here, is that investment strategies are generally done 18 months after year end. An investment strategy for 2019-2020 should already be done by now, looking at where we're going to go in light of our investment objective for the next income year. Then that might be ratified and taken again for the following year, but it really needs to be done on a year-by-year basis and certainly has to be in writing. An investment strategy that is done, for example, at the time of audit or audit sign-off in, say, May 2021 for the year ending 30 June 2020 is not an investment strategy. It's simply a recording of, or historical recording of the actually underlying investments of the fund, and is not an investment strategy. So that's the danger, because if there's no investment strategy in the fund per se, then what happens there is we can then move down. If there's no investment strategy, then effectively, if we have a look at section 55(1) of the SIS Act, then means there's been a breach of the governing rules. Because the governing rules, even if the trustee doesn't incorporate it, section 52B2F, in fact, all section 52B2 governing rules which are deemed to be imported into the trustee of the fund. And one of those is, of course, the investment strategy rules. Now, the danger about that is if we then go in and have a look at section 55(3) of the legislation. In fact, I might just take us there because of you guys, I won't do this later on, but for you guys, I think it's absolutely pretty crucial. I'll just do a bit of a Google search up on, there we go, of the section 55(3), the SIS Act. So if I go and have a look at this, so you can see up here, hopefully, I'll try and blow it up a bit. It's not the best there, but section 55(3), so recovering loss or damage for contravention of a covenant. So again, the superannuation fund must put in place an investment strategy. And we're going to have a look at what the Commissioner says in that a little bit later on. If there is no investment strategy, then there has been a breach of not only the deed, but also Section 55(1) and also Section 52(b) 2F. So then we drop down here, and this is absolutely crucial. So subject to subsection 4, and you can see this, a person, and by that, I'll just get my little annotator out here because, you know, I love that. I think I got that when I was a kid. So a person who suffers loss or damage as a result of conduct of another person that was engaged in contravention of Section 54(b), 54(b)(2), and 54(c) may recover the amount of loss of action against that other person or against any other person involved in that contravention. So when we have a look at that, effectively from that perspective, is that if there is a loss, then if there's been any person involved in that contravention, which could include the auditor or the accountant, effectively the member or any other person who suffered loss can recover against that person. Sub 4 says, unless an action under subsection 3 is of kind dealt with in 4A to D, it may be begun at any time within 6 years after the day on which the cause of action arose. Now, we then go down to subsection 5. It is the defence to an action for loss or damage suffered by a person as a result of making an investment by or on behalf of a trustee of a super entity if the defendant establishes that the defendant has complied with all the covenants referred to in sections 52 to 53 and prescribed under section 54A that apply to the defendant in relation to the act. So if we then go back to this, and I've got a little slide here. So obviously, if there's no investment strategy or investment fits outside the investment strategy, remember we just had a look at 55(5) defence, then what would happen here? So we've got XYZ ETF that is on the books of the account right at this present point in time. We haven't done an investment strategy for the fund this year. We may be able to argue that there's one from the last year. But the ETF has fallen in price by 20% and a $50,000 loss has been booked. So the question is that who's on the hook for that? Can the members of the fund or the trustee of the fund, remember they're persons who suffered loss or damages, can they argue that because there's been no investment strategy, that investment itself effectively falls outside the covenants, and hence there's been a breach and a recoverable action under section 55(3). So I would argue that it's definitely the case, and that potentially whoever touched or prepared that investment strategy, and more importantly, signs off on it. And I think the auditor's in not a bad position here because the auditor needs to be careful, but for the 2019-2020, the auditor doesn't see that until later on. What my recommendation here is that when we do investment strategies for clients, and we should really be doing them, we should have done them in the first quarter or do them in the first quarter of this financial year, and then send them over to the auditor to get sign off. So rather than wait until the finish of the income year when it's too late for the auditor, get the auditor involved at this present state of mind. At the end of the day, though, because of section 55(3), you really need to make a choice as whether to do an investment strategy or not. So let's go and have a look at the letters that came to our clients. So this is one that was received on the 29th of August. So we really need to work through what we've got there. I'll just blow it up a little bit there so we can see it. Some of you have probably read this, but let's dissect it. Dear trustee, and again, this is a bit scary, our records indicate your self-managed super fund investment strategy may hold 90% or more of the funds in one asset or a single asset class. This means that your fund may be at risk of not meeting the diversification requirement as outlined in the operating standard of the SIS regulations. In fact, I'm surprised the Commission didn't pick up the SIS Act, but it doesn't matter. As a trustee, you are ultimately responsible for ensuring your investment strategy meets the requirements under the law. You could also be liable for administrative penalty of $4,200 if your investment strategy fails to meet these requirements. Now, that $4,200 penalty, we're looking at diversification now, which is a real drill down inside the investment strategy. So really, if your client's investment strategy doesn't doesn't carry through or really doesn't match up to things, then effectively you're going to get caught and there's potential $4,200 fine. And again, if there is a fine and there is no investment strategy, then 55(3) will allow recourse to the administrator and or the audit, also potentially the auditor. So we just got to be careful. So what you need to do, you need to review your investment strategy, make sure it complies with the law. In particular, you need to be able to provide evidence, that's obviously going written or writing, ideally within a written investment strategy of how you consider the following: diversification of your fund investments, the risks associated with inadequate diversification within the context of your SMSF investment portfolio, the making, holding and realising the likely return for your investments having regard to your retirement objectives, so that's investment and expected cash flow, the liquidity of investments, meaning the ability of your fund to pay benefits as members retire and pay other costs incurred by your fund, whether to hold insurance cover one or more members of the fund. Have your investment strategy ready to provide to your SMSF's approved auditor as part of your next audit. This will help your auditor form an opinion on your fund's compliance with these requirements. So what happens now? We will also be writing directly to the auditor of your fund to notify them of our concerns. You should be aware that if your auditor identifies that you failed to rectify any non-compliance with the requirements listed above, that could result in the imposition of the above-mentioned penalties. So for me, that's a pretty hardcore letter to go to trustees. It's like, well, we're gonna start to be pinging you from that, and as a consequence of that, I think we really need to take that in to go. But notice how the Commission actually starts to put 52B 2F in there and 409. It's actually a broader investment strategy there. I've got a couple from Zach. I've got, are we going to get a copy of the notes today? Yes, I'm going to give you a whole lot of actual stuff to do. So I've got real-time stuff, so there won't be notes, but there will be a recording of this, so you'll get that. Now, with the auditor one, the auditor letter, effectively it's much the same, but it doesn't talk so much about diversification, it talks about the entire investment strategy. So from my perspective, auditors are now virtually put on notice for all investment strategies. So we need now to go and progress and work out a strategy for that. So what I've done is I've just done a couple of things. We've beefed up our light year docs. So this is for you what I will do. So we've got our support centre here. If I go to light year docs, you'll see I'm going to go through the investment strategy a little bit later on. But if I just go to the home page, and you see up here the support centre. So that's where all of the videos, this video will be up there later on this afternoon. But essentially what we've got is the support centre. So inside the support centre, we've got find about our full document suite, which is being added to all the time, relevant things in the media, client documents and advice toolkits, FAQs, and all the webinars are effectively there. So, there's a whole lot there. If we just have a look at our strategy webinars, you've got advanced estate planning, leading member, advisor built, Stormont One's loan suite, binding death. There's a lot of stuff there if you haven't had a look at that. What I've done though is, if I go back to the support centre, you'll see here client documents and advice toolkits. So the leading member advice toolkit, we're coming around, we are doing a roadshow around Australia in October, so I'll give you a link to that. Because your light year docs users, the normal price of the roadshow is $245, but it's $145 for you guys. So for me, that's it's a great day. We're going to be spending from 9 o'clock until 4:30 just going through a whole lot of case studies, but I'll look at that a little bit later on. So we've got the client deed upgrade letter, which is a fairly hardcore letter to suggest to clients they should be upgrading their deed every 2 years. But this is the one we want to do. So what we'll do there is you can download this. This is in a Word doc format. You can see it just pops up here. And this is for your use. So what we've got here is a sample SMSF investment strategy and indemnity letter. So what we've got to do is two things. Have a look through there, but essentially what it does, it just really talks about the three options you've got for that. The first one is you're comfortable that the investment strategy covers all the requirements of 52B2F and also SIS Regulation 409. If that's the case, then you really don't need to do anything. You just go back to the clients and say that effectively, you're quite happy with investment strategy, the forward looking for 30 June 2020. Alternatively, the client agrees to update the fund's investment strategy for the 2019-2020. Look at that. You can use our your doc strategy automation, which I'll go to. Or importantly, the client doesn't want to go ahead and complete that, or ignores it and wants to go alone and do their own investment strategy. Then if that's the case, you really need to get an indemnity from the client, because the last thing you want to do is them saying, look, I don't want to spend the money for it, and then find out later that they're going to get sued under Section 55.3. It's not only just 55.3, there's also Section 218, where if there's a breach of investment strategy by any person, the trustee of the fund can recover against that person involved in the breach. So if they can tag you to the fact that you were supposed to provide the investment strategy, then obviously you're open. You want to get rid of that. So if we just go down, so this letter, which you can obviously just get up on our support centre, I'd probably, if this was my clients, I'd actually be sending this letter out to all of my clients. It's up to you, but bearing in mind that auditors are now being put on notice to review all investment strategies, and the fact they're forward-looking, I would start to think about going through and having a look at what we've got in place now for 2020, and more importantly, look at perhaps what we had at 2019, because the audits of those are coming up very shortly in the next 4 or 5 months. But I want to get in, really, we should have had those in squared away, and we should be looking at the audits now. In fact, the auditors who are listening to this, it might be ideal to actually go out to your accountants and administrators and find out where the investment strategy is now for 2020. That's what I would suggest. Anyway, here's a letter. Urgent Commissioner of Taxation Blitz on fund investment strategies. A number of our clients have received letters from the Commissioner of Taxation stating the following. So I've just excerpted a little bit from there. So it's really, it's all the stuff that comes straight out of the Commissioner's letters there. Importantly, investment strategy is a forward-looking document. The trustee must have one in place for the income year ending 30 June 2020. This should be completed in the next 60 days before we advance any further into the financial year. As I said, the further you get in, it's very hard to justify the investment strategy. Given the Commissioner's blitz on SMSF investment strategies, the responsibility of the trustee to complete one for 2019 and 2020, and the possible $4,200 fine, we highly recommend an implementation review of the current year's investment strategy. We're happy to conduct for the trustee of the fund, for the trustee of the fund to get the investment strategy into full audit shape, and with relevant work papers, trustee minutes, and relevant reference mirrors and guidelines, which I'll take you through shortly. The fee for this service will be, my suggestion, because there's quite a bit of work to be done, is $350. Now, it's up to you. If you're charging an ongoing subscription fee for them, then you might just do it as of right and just say, look, we've got your back. We'll go ahead and do it. It's important but otherwise, charge a fee. It could be 100, 150, 350, whatever you want to do. And I'll talk about the pricing like your docs shortly. It's important to complete this task immediately, given where we're at in the 2019-2020 income year. Alternatively, you could review the fund's investment strategy yourself, having regard to all of the above factors. Can you please tick one of the boxes below on this urgent matter and sign underneath and send back? First off, we hereby seek to proceed with the detailed fund investment strategy review in preparation to meet Legislative Commissioner of Taxation guidelines for the fund. Sorry, there should be a full stop there. I'll fix that after. We'll invoice the fund $350 for this service. Or alternatively, no tick, and this is the important one for you, no advisor review of the fund investment strategy. We hereby disclaim all liability for damages, costs, and any fines for our professional SMSF advisors. And instead of that, you can actually put your name in there. This is a Word doc, so please, it's not a PDF, so please adjust as you see fit. In relation to funds investment strategy in the event of any compliance, litigation, or ATO actions as a consequence of running the fund with an invalid investment strategy. That, if they don't want to go through this, this is an absolute must tick, and then obviously get them to sign as trustee of the fund. That will at least indemnify you from that process. So for me, that is absolutely crucial. That's my absolute crucial perspective there. So let's go in and have a look at the investment strategy guidelines, which we've just updated in the Lightyear Docs. So what here I've got is, I'll go through and build it for you. Again, please feel, and I'll talk our way through it Lightyear. Sorry, investment strategy. So I find this is the easiest way, just go through the search. So I've got the investment strategy for the fund. Now you can see here, as I go through, sorry, I'm a LY strategist, which is someone who's either under license. I think we've got about 25 licenses out there, which is $6,900 per year for unlimited documents, CPD, etc. Alternatively, you can go on a month-by-month basis, which is $795 per month. Or alternatively, if you're what we call an LY basic, so you're pay-as-you-go, the SMSF investment strategy for the fund is $49, again, which is, if you're charging $350 for that investment strategy review, and you're only paying us $49, you're doing well. But obviously, if you are on unlimited package, it's going to be even better, which I'm here. So we go through and start the document. I can put it into one of my folders, but I'll just start up a new folder for us today. And I'll keep this going for a little bit later on when I go through for the other guys. So what this does, this boots up our, the world's most advanced legal precedent system. So what is the name of the fund? So that's pretty easy. The Smith, I'm just showing you what to do, the Smith Family Super Fund. So that's okay. On what date will the investment strategy be established? I would say there we go back to the 1st of July. What is the end date of the current income year? So we've put this in because we could go back and find ourselves at 1st of July 2018, which would be ideal. Again, what we're doing is referencing this because if we go back to the Commissioner's guidelines and see here, the element that we need to go through is, what we've got to do there, your investment strategy will help your fund form an opinion on that. So here, this is what I'm after. You need to review your investment strategy, make sure it complies with law. In particular, you need to be able to provide evidence, ideally within a written investment strategy. So we need to actually show within our document effectively when it was for, and more importantly, what date it relates to, what year it relates to. So I've got 2019, also 2020. Whoops, sorry about that, guys. Was a current end date. There you go, I'm getting too excited. 06 to 020. So this is for the current year. Now, of course, we can use it for evidence. So then we just put in the trustees' details. We are in the process now of integrating with BGL and also Class Super. So this will be obviously a lot easier as we go down the track, but we'll call it Smith nominees. So we just put that in. Always comes in with PTY Limited. I just do the ACN as required. Put the registered office address. DT Smith Street. Just tab down. Sydney. I was doing this the other day, and poor Michael from our office was showing at the class conference, and unfortunately it was so slow. So we've got two directors there, and we need to make sure that they both sign off. You can have obviously as many as you want. So I confirm that. You can see up pops the director's details. So the first one is we've got John Smith, and he's going to sign off on the investment strategy. We've got Judy Smith. Now what we do is if we don't tick this box, then they don't sign off. So given it's an investment strategy, we should sign off. So on what day will the trustee meeting be held? Leave that blank, but ideally it should be more towards the front of the income year if you get the address. Where will the trustee meeting be held? Ideally it's going to be at your offices or the registered office. So we've already put that in, so we can just select and that will pre-fill it. The chairperson, who's going to be that? And we're going to have John Smith will be that. Okay, so that's the start. Now we get into the benchmarking. So all we need to do is we can put in, you don't need to add percentages, so we do benchmarking. So here, it's invested by bank accounts, bank bills, similar other securities. So this comes straight out of the document. So let's go 0, and I'm going to do dash to 40%. International cash, so let's put a 0 there, or NA, either one is fine. Domestic fixed interest, again, have a look at all these when you've got a chance, because it tells you where it's, what it is for and what the benchmarks and why you'd be going into that. No fixed interest, no international fixed interest. Next, so again, equities, nothing in equities because this is a property fund, not applicable. But it's not a bad idea, because at least if we have all of this, it means we have considered all of these assets for diversification purposes. If it's not in there, as you can see, if it was 0 to 100% over every asset class, that is not investment strategy. Okay, so we've got domestic property. So we've got one here. Let's say we could run at maybe 40 to 95%. So that means we go above. So this includes syndicates, managed funds, etc. Now, what I've done is remember the Commissioner's ruling related to over 90%. My feeling is that if you'll see when we get into the document itself, that look, if you invest in more than 50% of the assets of the fund, it's probably not a bad idea. So when we have a look, let's go residential. And if we have a look, what's the residential allocation? So we can go 0 to 40%. And let's say we go commercial. So we've done business real property there. So we can go 0 to 55%. So I think, actually, I don't think we have to put we'll see anyway. We'll see what happens. I was going to say, I'm not sure about the percentages. International exposure, international property is not applicable. We then go to alternative assets such as hedge funds, private equity, blah, 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 not applicable. Next one I really love too is the borrowing benchmark. So what we can do is we can say we've got 30 to 60% LVR on the borrowing. Again, we don't have to add the percentage. This one, we can actually create a customizable asset class. So, for example, we could put gold, put the key characteristics of the asset class, the time frame, the benchmark allocation, if we want, but I'm not going to do that for this one. So we do have, if you have a look in our support, like ATO Docs, if I go into the webinar, I've got quite a detailed, I've got a detailed, I think in here, it's somewhere in there, investment strategy already. Maybe it's trust laws. There it is, investment strategy. So if you want to go into the investment strategy and have a look at all me doing gold, etc., that's probably the place that you essentially want to do it. So let's go to the next, and that will take us into the document. I'll go through what we've done with the document. It's a little bit different. And this you'll see there's a difference between the ordinary investment strategy and this one, because I've gone property. I've ticked over the 50%, what happens there. So we're just rendering this. So I'm going to download the document there. Again, feel free to go in. For those, particularly those of you who've already got the unlimited, just go and start building and having a look. So we've got the investment strategy guidance statement for the family super fund. I'll just open it up a little bit for you so you can see. What I've got there is, first off is, it's not because investment strategy is not a financial product per se, because we're not dealing with specific investments. This is not a PDS, but what we do is it's a guidance statement for the client and the trustee. So we go through this, the fund's investment strategy, the importance of the trustee, trustee versus CISA. We look at investment objectives and the ATO guidelines. Again, it's a good thing to re-emphasize this. And remember, strategy is forward-looking. The 5 steps to investment strategy, looking at investment objective, developing an investment strategy, building a portfolio. Got ASX there, but of course, obviously it's going to be property. Choose investment style, which could be, look, is it retail, domestic, rural, etc. Again, I focused on investments. Choose your investment types, and then choose the underlying investments and insurances in the fund. And I've even put in a bit on trauma insurance there, that you obviously can't do that. So now we go into the investment strategy, the fund objectives, investment strategy, and benchmark allocations. So we go through a bit of a disclaimer there, but the fund's investment objective, in the past, I've seen a number of cases. We need to start with investment objective because you can't have a strategy unless you have an objective or a plan. So in the past, I have seen ones that say like CPI plus 2%, CPI plus 3%, which really doesn't work. So this is the investment objective. The trustee, via its investment strategy, seeks to maximise the fund's members' retirement benefits, including income streams and lump sums, as well as maximising any death benefits if the members' super benefits are not being used for pension purposes. So if we have a look at that, that's a good, strong objective. Then we go through the background, and again, you can see here, this is just a paraphrase of the legislation, and more importantly, the Commissioner's ruling. Asset allocation, we've got in there. As a key, the trustees looked at the risk, etc. Borrowing, we've looked at borrowing, and we look at that a bit further, you'll see that. Diversification to mitigate risks. So we've got quite a lot of stuff there. This is the additional clause that we have here. The trustee of the fund has decided to invest in residential and commercial property. Remember, we ticked those boxes there. If it was rural or whatever had come up, as a long-term hold. So, for example, if someone's 40 or 50 years of age and they're investing in these properties, then the danger is, if we have up here, diversification is best seen by the spread of the fund's portfolio across a broad mix of assets. At the other end, where the fund applies an asset allocation of 90% to 100% with property, 0 to 100% cash is exemplified by a single property, there is inherent risk that the property drops in value, which really is not an underlying inherent risk for someone who's 30 or 40 who can't touch that money until they're retired. Someone who's like 70 who's now buying new property, then obviously there's a diversification risk. Cannot be tenanted. That's obviously going to be the case if there, particularly if there's borrowings in and there's cash flow issues. Gets divorced, is retired, or needs a lump sum. A fire sale of the property to meet the trustee's cash flow needs to satisfy as a member request can result in significant losses. So that's covered in here, but we look at the cash flow positive. So it's 10 years, and although the asset allocation is significant, the contributions of members and rents ensure the property is cash flow positive, with cash reserves to be diversified in the future. Regard has been had to the Reserve Bank Bulletin of September 2015, detailing long-term property trends in Australia. The trustees are comfortable, barring any immediate disaster, the cash flows and member benefits will increase over time to maximise retirement income through the holding of property. Reserve Bank Bulletin is seen at Appendix A. We then go down and have a look at balancing risk and returns, and this is straight out of, I forget where it's from. And then we go down here to the major asset classes. So you can see here we've got the domestic, and this is the actual take-up, which you saw investment strategy. We've got the short-term 0 to 40%. I've got non-applicable. You could probably I put NA, but it might be better to have a look at this now to go through and put 0%. So nothing in domestic fixed interest. Remember, we went through all of this anyway. International equities, domestic property. So I've got 40 to 95%. Remember, I put in the percentages. I shouldn't do that because obviously it automates the percentages. So sorry about that. So residential 40, 55, provides a benefit of diversification through access to blah, blah, blah. So it's medium to long term. International property, nothing. And then we've obviously got our borrowing put in there. Insurance in the fund, investment strategy, review and monitoring. The trustees will monitor the fund's investment activities on a regular basis. So remember, all investments, as per the Commissioner, have to be in line with the investment strategy. If you make an investment outside the investment strategy, effectively you fall foul of 55B. So what I've done, and for, if you haven't ticked that box, remember that 50% box, then this doesn't pop up. But if you do, then what I've done is quite an extensive paper by Marion Cole and Michelle Van der Merwe from the Reserve Bank Bulletin, and it goes through all the long-run trends in housing price growth to show that, that if we're doing a long-term hold, particularly when we have a look at housing prices versus CPI, that we are in a pretty good position. Again, you can't extrapolate into the future, but certainly they go through the housing supply, the lack of housing supply, debt to price income ratios, more importantly, the underlying demand and population growth increase, I like this one, the average household size, which also has an impact on the supply stock. So I like this as a really good, strong paper to back up the fact that you're investing on a long-term basis, and that probably it's a very smart way to do. And anyway, we put that in, and then we go down, and so that's your investment strategy. I've given all the references there, but and I probably will even look at doing that maybe for each of the asset classes where we hold more than 50%. But bearing in mind, through a lot of those guidelines, it's a lot in relation to equities anyway. So this is the acceptance investment strategy. We've got the trustee, John Smith is the chairperson. We adopt the investment strategy. It was resolved by the trustee to seize the funds, form investment strategy, so on and so forth. And then we sign it and then give notice of this to obviously have that. And that's effectively our investment strategy per se. So it's not that sophisticated, but sorry, it is actually, it's very sophisticated when you have a look at it. And certainly it's the best investment strategy I've seen. Compare that to your current existing investment strategies, and I think you'd be in for a bit of a shock. But look, I've got these other two documents I really want to share with you. But what I suggest is that because you guys are on the program, if you're not on an unlimited, at least contact us about either getting monthly unlimited or, more importantly, having a look at our license. A lot of our licensees actually buy the license through their self-managed super funds. So it's a great way of getting. So what they do is they buy it through the self-managed super fund, and then they charge the practice or the accounting firm the fee for preparation of those documents. So it's a great way of getting money from the family trust or the business into the SMSF. But if you want to know more about that, please contact me on our office number, or you can always get me on 0418 735 490. So again, I'd be really getting out and pumping out these investment strategies for the client. Get the letter out first. Obviously, for the clients who've already received the letter, you need to get this up and running for them straight away. Importantly, again, it's not a financial product. So if you're an accountant, you can prepare these, and I'd recommend you do, or make sure you get the indemnity for the client from that perspective. I'd also go down the track, and for all your clients, I'd be going out and putting them on notice. At least get them in line, send that letter out to them, and get an indemnity if they don't want to go down the track. So it's a pretty good opportunity, I believe, anyway, at this present point in time. Now, speaking of opportunities, let's go back to our the two we've got, the SMSF loan. So this pops up again. It's very easy. So because I'm unlimited, I can just pump it out. I'll just put loan here, start, and then this will pop up the SMSF loan. So what I'm going to do is I'm actually going to do a loan from the SMSF to my family trust. So I'll just go through the Smith Family SMSF or super fund. I'll do a company. So I've got SMSF nominees. And as I go through, I'll just talk about a couple of the issues here. So what we're doing here is it's best to actually look at it almost like a credit line facility that is provided by your SMSF or the client SMSF to a related party. And this can be, the only thing that can't be done, and please be wary of this, you can't lend to a member or a relative, but you can lend to a member's family trust or a relative's family trust. So we've got three directors here. So we've got John Smith, who's the senior person, Tab, his wife, Judy Smith, and the son, I'll call that Sam Smith. So this is the 40. So John and Judy are both in their 60s. Sam is just turned over 40, but he's inside the fund. Okay, the borrower's name is the trustee of the trust, and we'll call it Sam Smith Family Trust. Can you see what I'm doing here? So we've got in fact, I'll just go individual just to make things quick. So we've got one trustee, and we're going to do Sam Smith. We've already got the address there. Remember I showed that, so we'll just pop that up. So that's 5 Smith Street, assuming that's all the same. That's obviously your office if you're an accountant. Okay, so the date of the loan agreement, let's just put in today's date, so that's fine. Now, is the loan going to be fixed or variable? Let's use a variable rate. Importantly, if it's going to a related party, we need to find out T's and C's of a commercial overdraft or credit line facility from a bank. So just go to the client's bank or have a series of banks or have a chat with your brokers or whatever. And many of you have already got brokers in-house. Just find out what an overdraft facility is, and you just want to replicate that. So the commencement of loan, again, we can do it on the 12th, but if you leave it blank, then you can pop in later. So where's it going to be executed? Obviously here it's New South Wales. The principal loan amount, now if we've got $1 million in the fund, then we can go up to $50,000. I would suggest that effectively we make sure we don't do 50, because if the assets drop, then we've got a particular issue there during the year. But that won't be picked up at year end. So as long as we either increase our assets or whatever, we've just got to be careful. So the loan term's up to you. We just need to write that in. We could do, for example, a 1-year loan, but let's just do 3 years here. What's the commencement interest rate? Let's say we've looked at an overdraft facility and it's 6.7%. I don't need to put the percentage, that's already in there. Interest payable annually, let's just do quarterly. And I would always go a mortgage deed. And if it's in the family trust, I would just put over family trust. I should put the Sam Smith family trust assets. And the reason I do that is to reflect, let's do the mortgage deed at the current date too, is to reflect that this is arm's length. So I go through the process. It's not very sophisticated. Well, it is sophisticated. I mean, we've automated a brilliant document. The issue for you is it's a great thing to go and talk to the clients. Instead of going to the bank overdraft, it's now actually funneling money from your family trust to your SMSF. It's providing a good income stream there. So if we have John and Judy had this loan actually in the pension stage, so we're running separate sub-funds for investment strategies, which I will be doing a session on next week, or certainly at our roadshow. But here we've got, you do separate investment strategy, this funds income and a great source of income into the family SMSF. So we go through, we've got the loan agreement. Oh, sorry, didn't put the state of the borrower. So that was my fault. If you don't, go back and, anyway, I won't go into that at the moment. But if you leave something blank, effectively that's what happens there. So apologies for that one. Oops, where is it? There it is, sorry. So when you have a blank like that, it means I forgot to put in the borrower's state. So you just need to go back and relaunch it. I haven't got time to do that. So lender will lend money to the borrower, blah, blah, blah. So it goes on and so forth. Repayment of loan monies, all of that. And then essentially we go down and sign the agreements. And effectively we've got the borrower there, which is Sam Smith, which is the trustee of the Sam Smith Family Trust. And then the lender nominees. And then the terms of the agreement, 50,000, 3 years, 6.7, blah, blah, blah. So that's a great little document for you. You know, if I would say on a $50,000 credit, you should probably be charging maybe $1,000 or a couple of $1,000 to set up that credit facility, particularly if you've already got pension members in there. It's a great strategy rather than going looking at fixed interest. If they can lend money to their kids through the family trust, it's a great opportunity there, if you ask me. The other one that I want to show you is your family allowance. So again, I'll just go in here, family allowance, and this is absolutely crucial for you. So what we're doing here is, again, I'll start the document. You can always go through all this sort of stuff. So I'll put family allowance. So up we pop here. This is a new agreement to the system. So it's only been used from a few. So the provider is, generally it's going to be, I'd go the parents there. So that way it covers both of them. But, you know, if it's just a sole parent, you can do that. But this can actually be through a company or trust, or even SMSF. You can use this family allowance if you want to go directly from the SMSF out of a pension. Of course, you have to meet a condition of release. So the first parent's name is John Smith, and we go down to 5 Smith Street, Sydney. So now Settlement New South Wales. If I don't cover that, then that's where it comes up a blank. So add another. Remember, we've got the spouse. We've got Judy Smith. And then I just select because we've already got his details in there. So we've got the parents now locked and loaded in there. So who's the recipient? So it's not a borrower or lender. It's important to have this a relationship. So we can do it to an individual. So we can do it directly to Sam Smith, or we can do it to the family. So we're going to put the Sam Smith family. And who's going to be signing on behalf of the family? Sam Smith. Street address, let's say he's 10 Smith Street. Now this is where the family actually resides. Sydney, New South Wales, 2000. We then go next. So when does the allowance apply? Again, this should be like the investment strategy, and it should actually be poking up here. By the way, that SMSF loan agreements, if we do go through that process, and when we come around to the investment strategy, we need to put that in under fixed interest, put it under fixed interest. So I put a sum in there. This is the monthly allowance. So, and then let's say it's New South Wales, and then we go down to the next button there. So this is a family allowance agreement. Now the purpose here is to the parents supporting the whole family, and I'll go through the reasoning on that one. And because the whole family will then make all that family potentially dependents at any point in time, which opens up our strategic possibilities in terms of doing grandchildren pensions and all that stuff. So you can see John and Judy Smith, Sam Smith as the recipient. It's actually Sam Smith, the Sam Smith family, sorry about that. So I go through the payment of death benefits. So this is the family allowance. I've just put this in just to make sure that we're aware for the client why this is being done. Of course, what it's doing is a lot of clients actually have ad hoc provisions for the provision of benefits. Here's a great little a death benefit ruling from the Commissioner. Talks about provision of benefits to a child over 18, an adult child. They've been classified as dependent. So I've really beefed this up. Now, the agreement terms and conditions is the provider provides a regular family allowance. And this is, if you have a look at all the law, you need to make this regular, which is why we're doing it monthly. That can be used for paying school fees, buying clothes for the family, providing funds for acquisition of funds and services. And this is really the important one, providing funds for any other purpose to enhance the life experience and comfort level of all members of the family, which is essentially straight out of the relevant cases. The provider will provide a regular family allowance payment of $1,200 per month, except in cases where the provider is short of cash flow or must meet other financial circumstances. So if we're out for like 3 or 4 months, we still need to have a reasoning there, and we've put that in. We don't want the Smith family, Sam Smith family, actually coming in and challenging it. So then we've got additional costs, holidays, school events, confidentiality, jurisdiction and venue, and then it's executed by John and Judy as the parent, and effectively the recipient is Sam Smith and the family. So that's our family allowance. Again, something else for you to go out. Probably if we have a look at that, that's 3 strategies. I'd be looking at investment strategy first for our clients. I'd certainly be going and having a look at the setting up that overdraft facility. The other one that we've got that I think is really important for all of you to look at, I've got a full day case study workshop on all of these particular issues. When we go down and have a look, there's a little video there for us. I just want to show you where you guys go. So we go to early bird tickets. So this takes us to the page. I've got here all what the background is, but look, I've got 20 strategies and lots of case studies. So we're going to be looking at family protection, so that's leading member versus simple SMSFs. My top 5 contribution strategies. One of them is obviously, there's quite a lot there when we're going to look at, for example, going from Sam Smith Family Trust, employing both John and Judy, making contributions with family allowances and lot. Business asset transfers, we're going to look at investment strategies, sub-funds, lots of property development and equity installment warrants, unrelated investment trusts, 1322C trusts, both of those are coming out next week, JVs and income screening. And then in the afternoon, we're going to be going heavily through estate planning. So I'm going to take you through a lot of strategies in relation to the preparation of wills, testamentary trusts. You'll be able to do that under our platform, plus what I call an SMSF testamentary trust. We're going to be looking at blended versus non-blended families and family wealth protection, essentially in there. And we're also going to be looking at bucket companies, family trusts, binding death benefit directions, reversionary. So we're going to be looking at the whole thing, and that'll come up. You've seen our interview form, for example, that loan agreement that we did up here, where was the SMSF loan. I've got to take you see how automatically I just ticked mortgage deed, and suddenly the mortgage deed pops up again. So a lot of the automation, you'll find we're going to actually get into about 10 or 15 documents, but you'll be able to do it as quickly as we saw fit. So what we're going to do is just go in. We've looked at the roadshow. I'll go in now, and I'll probably, let's say we're in Adelaide. That will take us into the roadshow for you, which is on the 15th of October between 9, it's actually 4:30. We go through all the agenda there. And then if you want to get tickets, because you're Light Year Docs users, you would just go to this. So again, this only goes for a while. You just go 1 ticket, and that's $145. The early bird is $195. General admission is $245, but we want to order that now. Fill in your relevant details. It will be in Adelaide. It looks as though it's going to be the Hilton, but at this present point in time, we're still finalising that. So just go through this process and take that from there. Anyway, we're right on 30. We're right on 30 June. We're right on time. We've had a look at a lot of the particular issues from our perspective. We've looked at the ATO letters. We haven't looked at the auditor. We've had a look at the one that crossed our desk. Make sure you get back to the client, particularly those affected. I'd go back, look at our trustee investment strategy, look at the Light Year Docs investment strategy. If you're not on unlimited strategy, I'd go ahead and do it. In fact, I'd probably go and look at the licensing. If you want to contact me, Grant at ilovesmsf.com. Let's face it, if you've got 100 clients or even 50 clients, and that's at $350 a pop, that's $17,500 in revenue, and we're only charging you $6,950 for a 1-year license, and that includes unlimited documents for the whole year, including companies, trust, all these family loan agreements. So it's a pretty good strategy there. If you want to, so Bruce Bardell, having the SMSF take on a subscription to Light Year Docs and selling docs to practice, could this be seen as SMSF conducting a business? Bruce, generally that's a really good issue. A couple of things I'd address on that. One is firstly, have a look at just go running a business in an SMSF. On the ATO website, you'll find there's actually there's probably about 5 or 6 pages there that the Commissioner says that a SMSF can run a business, so it's not a big issue. My preference though, and it's a good thing, is that generally most of the licensees have set up, they might be doing it. In fact, I did one the other day where there was 2 of the principals of the firm. They also added some of their employees. I won't name who, but for those people on the very smart strategy to lock in client employees. I thought it was a great idea. They pay for the license, and then effectively what happens, it's a superannuation unrelated investment trust, which we prepare for you with relevant details, which means it's outside the in-house assets. And of course, once you get up to an unrelated investment trust, you can conduct business in that, and there's no drama. In fact, you can, if you wanted to, you can borrow to actually buy the license. But essentially what you want to do is use your SMSFs. If it's 6,950, there's two principals, then that's like $3,500 a pop to effectively get that. And usually the licenses go for 5 years with a 5-year option. But Bruce, if you want to contact me, and I can take you through it further in detail. But anyway, this is me signing off. Good luck with all of that. But, there's a really good opportunity from my perspective to go out. One, we have to, given the downside, to either, one, the clients are on board to review and implement the investment strategy, or secondly, you effectively get an indemnity there for them. Auditors on the call, you should really be going to your clients and having a look at the 2020 investment strategy now. Anyway, I'll have this up and running for you by early, in fact, hopefully very shortly. So it'll be sitting up on our support centre. Anyway, it's Grant Abbott signing off. And remember, that letter is on our support centre for all of you to use.